In GCSE and IGCSE Business, there are a small number of financial formulas that appear again and again in exam questions. The good news is that once you understand these formulas, they can become some of the easiest marks you can achieve on the exam paper. In this video, we will go through the key finance formulas you need to know. For each formula, I will explain what it is used for, show you the formula, and then give a simple example. To make things easier to follow, we will use the same example business throughout the video. Our business will be called Coffee House Limited, a small cafe selling coffee and cakes. Let's begin with revenue. Revenue. Revenue is the total income a business receives from selling its products. The formula is revenue equals price multiplied by quantity sold. Now let's apply this to Coffee House Limited. Coffee House Limited sells a cup of coffee for $5. On a typical day, the cafe sells 200 cups of coffee. To calculate revenue, we multiply the price by the quantity sold. 5 multiplied by 200 equals 1,000. So the cafe earns $1,000 in revenue per day from coffee sales. Formula 2. Cost of sales. Cost of sales represents the cost of producing the goods that were sold during a period. The formula is cost of sales equals opening inventory plus purchases minus closing inventory. Let's apply this to Coffee House Limited. At the beginning of the month, the cafe had coffee beans and ingredients worth $500. During the month, it purchased additional ingredients worth $2,000. At the end of the month, it still had ingredients worth $300 left. So we calculate 500 plus 2,000 minus 300. That equals $2,200. So the cost of sales for Coffee House Limited is $2,200. Formula 3. Gross profit. Gross profit shows how much profit a business makes before paying expenses such as rent, wages, or electricity. The formula is gross profit equals revenue minus cost of sales. Suppose Coffee House Limited makes $5,000 in revenue from coffee and cake sales. Its cost of sales is $2,200. To calculate gross profit, we subtract cost of sales from revenue. 5,000 minus 2,200 equals $2,800. So the gross profit for Coffee House Limited is $2,800. Formula 4. Net profit. Net profit shows the final profit made after all business expenses have been deducted. The formula is net profit equals gross profit minus expenses. Let's return to Coffee House Limited. The cafe has a gross profit of $2,800. However, it also has expenses such as rent, wages, electricity, and marketing. These expenses total $1,200. So we subtract expenses from gross profit. 2,800 minus 1,200 equals $1,600. So the net profit of Coffee House Limited is $1,600. Formula 5. Gross profit margin. Gross profit margin measures how profitable a business is at producing or selling its products. The formula is gross profit margin equals gross profit divided by revenue multiplied by 100. Using our Coffee House Limited example, gross profit is $2,800. Revenue is $5,000. First divide gross profit by revenue. 2,800 divided by 5,000 equals 0.56, then multiply by 100. The gross profit margin is 56%. This means that 56% of revenue remains after paying the cost of sales. Formula 6. Net profit margin. Net profit margin measures the overall profitability of a business. The formula is net profit margin equals net profit divided by revenue multiplied by 100. For Coffee House Limited, net profit is $1,600. Revenue is $5,000. 1,600 divided by 5,000 equals 0.32. Multiply by 100. The net profit margin is 32%. Formula 7. Current ratio. The current ratio measures whether a business can pay its short-term debts. The formula is current ratio equals current assets divided by current liabilities. Let's apply this to Coffee House Limited. The cafe has current assets such as cash, ingredients and money owed by customers worth $20,000. Its current liabilities such as short-term debts and unpaid bills total $10,000. 20,000 divided by 10,000 equals 2, so the current ratio is 2 to 1. This means the business has twice as many short-term assets as short-term debts. Formula 8. Acid test ratio. The acid test ratio is another measure of liquidity. However, it excludes inventory because inventory may not be easy to sell quickly. The formula is acid test ratio equals current assets minus inventory divided by current liabilities. Coffee House Limited has current assets of $20,000. Inventory, such as coffee beans and ingredients, is worth $5,000. Current liabilities are $10,000. First, subtract inventory from current assets, $20,000. Minus $5,000 equals $15,000. Then divide by current liabilities. $15,000 divided by $10,000 equals 1.5. So the acid test ratio is 1.5 to 1. Break-even analysis. Break-even analysis helps a business understand how many units it must sell to cover all costs. Once the break-even point is reached, the business begins to make profit. Formula 9. Contribution. Contribution shows how much money from each sale goes toward covering fixed costs. The formula is contribution equals selling price minus variable cost. At Coffee House Limited, a cup of coffee sells for $5. The variable cost, including coffee beans, milk, and cups, is $3 per cup. 5 minus 3 equals $2. So each cup of coffee contributes $2 toward covering fixed costs. Formula 10. Break-even output. Break-even output calculates how many units must be sold before profit is made. The formula is break-even output equals fixed costs divided by contribution. Coffee House Limited has fixed costs such as rent and salaries of $2,000 per month. Each cup of coffee contributes $2, so we divide fixed costs by contribution. 2,000 divided by 2 equals 1,000. So Coffee House Limited must sell 1,000 cups of coffee to break even. Formula 11. Margin of safety. Margin of safety measures how far current sales are above the break-even point. The formula is margin of safety equals current sales minus break-even sales. Suppose Coffee House Limited sells 1,300 cups of coffee per month. The break-even point is 1,000 cups, so we subtract break-even sales from current sales. 1,300 minus 1,000 equals 300. So the margin of safety is 300 cups. This means sales could fall by 300 cups before the business starts making a loss. Conclusion. Those are the key finance formulas you need to know for GCSE and IGCSE Business. If you understand these formulas and practice applying them, finance questions in the exam become much easier. If you found this explanation helpful, consider subscribing for more GCSE and IGCSE business revision videos and exam preparation guides.